Yo, hello everyone. This is Brain FX. I'm bringing to you the high to the power of 3. I know most of you know what it is, and some of you do not know. For the purpose of those who do not know what power of 3 is in forex market, uh, this is why I'm making this video for you to simplify what ICT actually means with power of 3, how you can use the power of 3 as a tool or an arsenal to be profitable in the market, or how to anticipate a potential move in the market, right? That's the actual essence of the power of 3. You are able to anticipate a future move in the market. So when you understand what the power of 3 is, you would know what to expect. Your expectation rate will be high. You wouldn't spend a lot of time on the screen. You would know what you are looking at, right? So that's what the power of 3 is. And what are the 3 major things we're looking at? The accumulation, the manipulation, and the distribution. This is more of a daily cycle in the market. That's why ICT use the bar chart line to explain the power of 3, where we have this in the bar chart, right? So if you know this, you would know your expectation. So that is why we have this like this in the bar chart, right? So we have a open, range, and close, right? So now what is the importance of the power of 3? The first importance is that it helps you to identify the engineering of liquidity. It helps you to neutralize liquidity, market making, and pairing as well. So the engineering of liquidity, how does the price movement works, right? Price movement works by creating liquidity and grabbing liquidity. So your old lows, your old highs, your range markets are always liquidity in the markets. And how do they neutralize? So what happens before neutralizing of the liquidity? So neutralizing liquidity means price find its way to take out retail stops, to take out a lot of stops in the market, either your hold lows, your sell stop, your buy stops at liquidity which have been neutralized by the smart money, right? So market making and pairing. Now, this market making is the terms in which the smart money is buying, the retailers are selling. So what do? They buy into our sell stops, right? They buy into our sell stops. So this is how they are able to pair their orders with us, right? So this is the context of market making and pairing. So this video will be made short so that you can watch them over and over again and backtest them on your charts. So how do you identify what is accumulating, right? Let's say when the market is about to sell, the market is decided to sell. What did smart money do? How does smart money think? So you should be able to understand how smart money think, what smart money do when we have accumulation, right? So identify what is accumulating, you have to identify what is manipulating, which is engineering short of liquidity, right? So when the market is accumulating means market is consolidating buy orders, right? Market is consolidating on buy orders, right? So when the market is accumulating, we see a lot of consolidation phase before an impulsive move, before an expansion to the upside. So what do we have resting above the accumulation? So what we have resting above here is what? Buy orders, because we have a lot of traders who are looking to take a buy positions right there. So we have a lot of traders who are trading the break and retest of the accumulation, right? So they were jumping to take a long position above that structure because they believe that a structure has been broken, and they play the retest. They have their buy stop right there, and by execution orders above that level. So what is smart money doing? Smart money is buying into their order as well so that they could sell. So smart money have their sell above the accumulation, while retails have their sell buy above the accumulation. So smart money is doing the opposite of what retail is doing, right? That's the way the algorithm works. They picture out a level of liquidity, they sweep out liquidity, and they move price in that intended direction. What is the purpose of the accumulation, right? To create liquidity, to engineer liquidity. So accumulation is a term for what? Engineering of liquidity, right? So they accumulate orders, they bring more liquidity into the market. Traders are looking at breaking out trade to buy. Retailers are looking at buy stops right there. So what they do is they manipulate price to the upside. They create long positions to manipulate retails. They trigger their buy stops in the market. So when buy stops have been triggered into the market, what happens? Retail starts adding buy positions. So when buy positions are being added into the market, what does smart money do? They distribute price back to the downside to take out retail stops. So identify what is manipulating, which is engineering short liquidity. So this is what? Yeah, this is a manipulation of what? Of the long liquidity. We have long positions sitting above here and they are being engineered by smart money. Above this level here, we have retail buying. Smart money are not interested into buying. Smart money are interested into selling. But how do they sell? They have to pair their orders with buys. So they volunteer a lot of money to buy in order to sell. So their buy orders is being paired. Their sell orders is being paired with the pair they've manipulated. So the buys have been engineered into the market by smart money so that they could sell off their position to clear out the sell stop. So you have to be able to identify what is accumulating, identify what is manipulating, right? What you call a breakout of your range is what smart money manipulates, is what you want to see as manipulation. And this is more of a daily cycle in the market, right? Price manipulates, price consolidates, which is accumulation, manipulates, and at the end of the day, distributes. So this is for a bearish trend, right? This is what you can see in a bearish market. So accumulation, what to see in a bear market? Accumulation of short liquidity by smart money. So they are accumulating orders here so that there can be enough liquidity for their short position. So the smart money intends to short the market, but then before then, there must be liquidity, which is money. The retail money is sitting right there. So the smart money engineer that so as to create short liquidity, because when the retails are buying right above that trend, when they are buying right above this level, their buy liquidity is below the range. So what is the buy stops below this? The stop loss of the buys below this range. That is sell stops for the market. So when you have your sell stop loss below that range, for the smart money, it is liquidity. So which is what? Short liquidity. They are accumulating short liquidity because buyers are having their buys above that and their stop loss below that. So smart money only push price to the upside to what? To accumulate short liquidity in the market. Again, what is their primary focus? Again, they are engineering long liquidity because when buy stops are being triggered, right, we have a lot of long liquidity which are going to be triggered in the market, right? Again, distributing and pairing short exits. How does smart money make money? When they manipulate price to the upside. They manipulate price with a fraction of their capital because they have the money to do that. And when they do that, they introduce new set of buyers into the market by retail traders, by traders who are taking a breakout of the market. So when they do this, the smart money start to distribute price back in order to pair their exits for shorts. So they get involved into short positions here when they've paired their positions with the longs from the retails, right? So they are able to get into short here and their exit is what? Is the retail stops from the long positions, right? So their exit from the shorts is paired by the retail longs because when smart money is buying, the retails are selling. So their exit for short is being paired by what? By the retail longs. Because for the long position of the retails, they have their stops below the range. And what did this smart money do? Their sell exits, which is sell within the distribution, is taken out and is being paired with the stop loss of the long positions. So this is how the smart money are able to manipulate traders, right, using the power of 3. So how can you use this to your advantage as a trader, right? You must be able to identify what is accumulating. You must be able to identify where the market is likely to seek. Now, let's go straight into the chart to look at that, and we end up the session for now so that we don't use so much minutes on these sessions, right? So straight into the chart, right? You will be able to identify longs, you will be able to identify shorts, right? So now you'd see that we have what? We have an accumulation phase, right? We have an accumulation phase right there. So you can see this as your accumulation, right? You can see this as your accumulation. So what is smart money doing? Smart money is engineering liquidity. They are buying long. Look at this candle. They bought the market long and they distribute for short positions. What is happening above this level? What we see above this level is what? Retails are trading longs, right? Retails are trading longs, and below the long position is their stop loss, right? They are trading longs after a breakout, right? After a breakout. So what is smart money doing? They are engineering liquidity above the long positions, right? So we have buy stops above this level. Smart money traders are engineering the long positions so that they could manipulate. So the move above this range is the manipulations. And the distributions was to clear out the sell stops, which is the retail stop loss for buy positions. So we have a stop loss here below the range, right? Because the retail traders are looking to long this market. And what did they do? They short the market. So I'm going to give you another example of that. So this is a typical accumulation. You know what's accumulating. You see manipulations and a distributions. So when you see this happening, you would know when the spam money come. Traders are getting involved, right? So an example to that is this, right? You can see this, right? We see some form of accumulation, right? You see market trade above that, right? So what did smart money do? They manipulate and engineered long positions, right? So below the range is what? Sell stops, which smart money is going to be targeting, right? So we can anticipate that what smart money is likely to target the sell stop of the retail, right? So because below this level here, there's a buy stop loss waiting below here for smart money traders. Now let's take one more example to finalize that. You can see here as well. Take an example to this, right? You'd see this level as what? Accumulation. Can you see that? You see accumulation. What does smart money do? They engineer liquidity to the upside. Now they are able to pair their short positions with the long from the retail. And what did they do? They sold price, which is distribution, to the downside to clear out what? Retail stops. So when price is doing this, you see some form of accumulation, right? You see some form of accumulation, expect a manipulations and distributions to clear what? To clear the low. So this is a typical power of three model. So when you invert the case for a bullish market, you will find a distribution, a manipulation, and accumulation, right? So this is how you can use the power of three to your trading tools to be able to identify what is going to happen, drawn liquidity, your old lows have been targeted, your old highs have been targeted, depending on what the market is planning to do. If it's planning to be in a bearish market, what they are going to do is they are going to push price firstly in a fake out direction before they finally move price in the intended direction. So when price is supposed to be selling, what smart money concept do, or what smart money do, is that what? They engineer liquidity for retails. They look at this bullish candle, look how impulsive it was, right? So they see this candle and retails are saying that, oh, now we have a bullish candle that break above previous structure. They are having buy positions. So what does smart money do? They induce them into buying. Once they are being induced into the buying, they start to redistribute. And where does the redistribution come? You can see distribution here to short the market. So this is how smart money engineer liquidity into the market, how they neutralize liquidity into the market, and how they pair and make for their pairing of currencies or pairing of short exits, right, in the distributing phase. So this is how you can use the power of 3 to your advantage, knowing what is going to happen, anticipating the potential move in the market, and seeing more opportunity in the market. You can go and backtest this on your market. You can go and backtest it. The next video is going to conclude, and we are going to see a lot of examples in the next video. Stay tuned. Please like, share, and subscribe. If you enjoy this, put your comments in the comment sections. Good luck and God bless you all. Peace out.